Okay, so if you've been sticking with me, this is going to be a kind of a roundabout way of kind of pulling all the videos that I have into just a one full thought and carrying it all the way across. So I'll focus a little bit on the EME hot money inflows, and I'll use the Brazilian real and Brazilian local currency bonds to kind of give that example, and also kind of detail, exactly what does it mean when you say the Fed is actually having a put in the market and the Powell put. And then I'll talk a little bit about short-term rates and how they impact, and then kind of go into potential. I'm not recommending these trades, but I'm just pointing out things that could possibly happen, and sort of kind of a high-level way of connecting all the thoughts and attempting to turn these ideas into trading ideas. So the first set of issues, I guess, and the first point is that there's going to be a GDP deceleration back towards trend growth, and that's being driven by future the pace of the working age population, low fertility rates, low productivity, and at some point in 2019, we're going to have a peak in hours worked. So who's driving that? And it's going to be the U.S. consumer. So households and businesses will continue to shoulder a substantial amount of global current account imbalances, forcing it at some point to peak. And what's driving the U.S. consumer is the tightness in the labor market will continue through 2019, which means that there's going to be an increase in disposable income. So we should see wage gains. Then you have the wealth effect, and psychological impact will lead to a fall in soft data at some point in the second half of 2019. And consumer expectations will gradually decrease throughout the year. So then, too, the trade deficit will continue to widen until it hits probably $1 trillion, or a little bit under $1 trillion, or close to it. Import growth will continue to exceed export growth on the back of the U.S. consumer and U.S. consumption. Strength of the U.S. dollar will increase in the first half of the year, which is mainly tied to and due to weakness in U.S. trading partners. Europe, China, and Japan are all growing at a slower rate, forcing the deficit country, which is the U.S., to make the adjustments. And again, the adjustments are felt through the consumer shouldering a disproportionate amount of global current account imbalances by actually consuming a substantial amount of goods, and mainly goods, but some services as well from our trading partners. So this is going to put pressure. The strength in the first part of the year on the dollar will likely put pressure on corporate profits. There's margin compression via wage growth and tightness in the labor force. Tariffs will likely exacerbate growth in domestic demand via increasing costs on both households and corporations. The third part of this is the fiscal deficit will increase to $1 trillion in 2019 and 1.1 trillion in 2020. Treasury will require savings from both foreign surplus countries as well as domestic financial intermediaries and non-bank corps that are flushed with cash. So while the U.S. consumer and households don't have a lot of savings, U.S. businesses actually do have considerably more savings. So banks, insurance, and cash-rich corporations will step in to absorb the issuance from the Treasury, as well as the reduction in the balance sheet from the Federal Reserve. Four, I think the Federal Reserve will continue to reduce the size of its balance sheet. So this year it's going to be between 500 billion and 600 billion. So ultimately they're targeting about 3.5 trillion in terms of the size that they think their balance sheet should be. That means that there's going to be about 260 to 280 billion dollars worth of treasury runoff and reductions. That has the effect of lowering excess reserves on the Fed's balance sheet, which are risk-free assets that pay an interest rate of about 2.4, 240 basis points. Same thing with MBS. It's going to run off about 175 to 200 billion dollars of runoff reduction, which is again reducing excess reserves, which are risk-free and pay about 240 basis points of interest to banks that hold excess reserves, which means that banks are going to have to look for assets that are not only safe but also yield comparable to the Treasury, which means that they could obviously they're probably going to have increased want for U.S. Treasuries as well as mortgage-backed securities. So the banks and financial intermediaries with access to the interest on excess reserves will need to search for assets that match interest on excess reserve yields, as well as risk-free characteristics. So, voila, there you have the U.S. Treasuries. So being able to absorb those over the course of the next couple of years is going to be heavily dependent on both domestic financials and non-financials that are cash rich, as well as continued flow of foreign savings into the U.S. To meet the twin deficit that on the fiscal side of it. So that will be met. So the next part of that's going to be met by foreigners running current account surpluses in major advanced economies. They'll be engaging in yield-seeking behavior because if you look at some of our trading partners, the larger ones, with the exception of China, but Japan and Europe, they have yields that are the yield differential between what they pay in their country versus what the U.S. pays is substantial. So they'll be in the position of seeking a place to put capital safely that has comparably large yield differentials and also growth differentials at this point. And this is 1 billion regardless of the currency swaps and gains, and 1 billion. I'm sorry, I shouldn't say 1 billion in currency swaps and gains, but they'll probably send this money into the U.S. Regardless of the currency swaps, limiting some of the gains that they would receive on dollar assets. They'll have to just accept the fact that the U.S. runs a twin deficit, and they'll probably also have to accept the fact that the U.S. dollar in the second half of the year and in through 2020 is going to depreciate. And now getting to what the Fed did today. And the fact that they may actually not raise rates for the full year of 2019, you could set up a situation where there could be a dollar crisis, but it's not going to lead to a situation in which bond vigilantes are going to be able to force U.S. yields higher. Even if you assume, in some of my other videos, I said that I think the Saudis are going to cut production in the second quarter in April. And that's going to force a change in inflation expectations due to the fact that commodity prices, crude oil in general, are likely to rise due to the fact that they're attempting to slow production to compete with shale oil, and they need medium and heavy sour crude grades in their country to go up in value so that they can close some of their government deficits and lead to more government spending. So anyway, the bond vigilantes won't have an ability to come in and demand higher yields. Unless the dollar were to depreciate significantly over the course of this, which the Fed kind of is setting that situation up by, if they should not hike at all during the course of 2019. Like I said, I'm planning, or I think they'll probably hike at least once in May. Luckily the U.S. is still the reserve currency, and it's the biggest and largest market in terms of depth and providing liquidity. So there's really no other alternative at this point. And even in 2020, when China opens their financial account and capital account, liberalization takes full effect, capital is not going to be able to rush in there. And this goes back to the Fed as well in terms of keeping interest rates too low, because again, now we're having a large market that we have to compete with in terms of having interest rate differentials that need to favor the U.S. so that we can get capital into the country to help with the twin deficit in terms of just the fiscal deficit that we're running. And that's more of a future issue in 2020. So the Federal Reserve accommodative policy, like I said, I think one hike in May 2019. Yield curve will eventually flatten, leading to an inversion. Markets will it will continue to flatten, leading to an inversion at some point. Markets will have to accept decelerating growth outlook in 2020, and long-term yields will also fall 10-year on 10-year and 30-year. Fed has some geopolitical global responsibilities in raising U.S. rates due to Chinese capital account liberalization in 2020. Fed policy makers really want to get the federal funds rate to 3%, but it doesn't look like it's likely to happen. 275 basis points may be the finishing point. So the market may prevent that later in the year. If the Fed were to hike in May, or some people in the market think in June is a little bit more likely, immediately the 10-year and the 30-year are going to fall because the market's going to have to price in a deceleration in growth into the later stages of 2019 and into 2020 and possibly through the first three quarters of 2020. Shorter end of the curve will start to fall second half of 2019 into 2020. Will have an impact on reducing yields on shorter duration assets, secured repos, unsecured LIBOR, secured SOFR, OIS, etc. 2-year treasuries will widen versus 2-year emerging market local currency debt, which brings me to the EME hot money inflows into, I'm using Brazil as this example, into local currency bonds. So a U.S. trader benefiting from weakness in the dollar, buying local currency bonds in Brazil is likely to benefit from the one, weakness in the dollar, two, the interest rate and growth differentials between the U.S. and Brazil. And we'll probably be able to see a substantial gain on those assets that they're holding in the EME. So the eighth part of this, I guess, is that certain interest rate trades will likely be profitable. So swaptions, selling premium and collecting income on swaptions if interest rates were to continue to move lower. Buying premium through swaptions and hedging risk to the downside are actually likely to be profitable as well. Trades using repo financing, so industries that or sectors of the economy that do that, like mortgage-backed securities on REITs. Long duration zero coupon treasuries are likely to move up in value significantly. POs, which are just principal only interest on long duration strips of mortgage-backed securities or treasuries, are likely to be very profitable. Utilizing balance sheet, for example, if a hedge fund wanted to utilize its balance sheet in combo with falling repo yields to finance purchases of long treasuries and get more leverage, as yields are likely to rise, and as yields are likely to decline and prices are likely to rise for U.S. treasuries going further out into the end of 2019 into 2020. Yield curve flatteners, you could be short the 2-year and long the 10-year, which is the TUT spread, or short the 2-year and long zero coupon bonds, which will again likely appreciate in value if what I'm saying is if my forecast were to come out. Also, euro dollar spreads. If you're selling the shorter end in 2019 and buying the longer end in 2020, the spread is likely going to favor the longer duration. Financing via repo and loading up on periphery euro debt, Italian bonds is what comes to mind. This is obviously a very risky trade, but again, same similarities where you actually are financing it through shorter repos and attempting to provide leverage and basically take the net interest differentials between what you're paying on the repos and then what you're getting on the yields. Could be a very profitable trade. Volatility is likely to be higher in the future, and a lot of that has to do with the MBS private sector and dynamic hedging as the Federal Reserve reduces those holdings over the course of this year. That is definitely going to put more volatility back in the market because private holders of MBS are going to have to use dynamic hedging, which involves shorting treasuries and engaging in interest rate swaps and other derivatives to reduce the risk. Vertical spreads using commodities like gold, silver, and oil could actually benefit bullish vertical spreads. Because I think commodity prices are likely going to head higher due to the depreciation in the US dollar in the second half. Short risk bonds via buying CDS protection. So essentially your long volatility in gamma via single name credit default swaps on maybe triple B rated debt, and you're kind of hoping there that there's a credit migration possibility because of weaker earnings and an increase in company leverage. Maybe that plays out over the course of the next 5 years, and you could make money. You could also buy out of the money 5% put and S&P index and sell a credit default swap protection, so you're receiving the premium payments on the investment grade bond index, and you're just trying to grab positive carry between the cost of the put and income bought from selling protection. So in general, long volatility via options, butterflies on the index in the second half of 2019. These are just some ideas that I'm throwing out there based on kind of where I'm looking at the market. And so then if you want to think about what exactly is the Powell put, it's ultimately an adjustment in the exchange rate. A downward adjustment in the exchange rate leads to higher corporate profits, increase in base money. It increases inflation expectations. It lowers real yields. And it also increases equity prices, and obviously has a downward impact on interest rates. So the way to think about this is through short-term rates. So if you look at some of the short-term rate financing, you can kind of look through the screenshot and how I have the federal funds rate, federal funds effective rate, general collateral repo financing rate, overnight repurchase rate, 3-month LIBOR overnight funding, interest on excess reserves, 2-year swap spread and the 2-year swap rate, 2-year treasury rate and 10-year treasury rate. So a lot of this deals with unsecured financing versus secured financing, in some ways that you can actually arbitrage that and benefit from utilizing the way that those spreads pay out. So if you're looking at 3-month LIBOR minus general collateral repo financing, you could possibly get 37 basis points of cheaper financing using general collateral, which would be leveraging your balance sheet and putting assets that you have sitting there into the market and lending them out so that you could actually get cheaper cash and then go out and buy assets that are yielding substantially more. If you were to do a 3-month minus 3-month LIBOR minus the interest on excess reserves rate, that's more of a bank. You would be more tempted to put money in an unsecured financing, so you can earn more money versus what you would have leaving your excess deposits at the Federal Reserve. 3-month LIBOR, overnight reverse repurchase. I'm not going to go through all these. You can kind of just read them and look through them. But ultimately, I think the biggest one is that the way that I'm forecasting the 10-year and 2-year Treasury spread is that I see it inverting in the fourth quarter of 2019 and into Q1 2020, and everything kind of rolls together. So you can kind of figure out how I kind of came to the conclusion that I did with some of the other videos, and I'm kind of just putting it all into one thought process and one idea. And so those are some of the ideas. There are obviously some things that could act against this. At this point in time, I stick to the Fed hiking once. The market's obviously extraordinarily bullish after today's meeting, and the accommodative Fed is sort of in there, and there's probably going to be a lot of money that actually flows into emerging markets over the next maybe before the start of the second quarter, but at some point during the start of the second quarter. But it also, again, like I said, there's some blowback that could happen for the Federal Reserve if they were to stay on hold for too long. They risk possibly a dollar crisis, which would require them to ultimately hike rates, or could possibly require them to hike rates at a point where they don't necessarily want to hike rates, because maybe you get the jump in inflation expectations because of the Saudi Q2 production cuts that puts upward pressure on commodity prices, or you're in a situation where the Fed remaining extraordinarily accommodative puts significant downward pressure on yields due to the deceleration in the economy and GDP over the course. So there's a lot of things that could actually be very, very bad because of this, and it also kind of puts risk on sentiment back in the market that also ultimately is going to probably be sold off, and volatility is probably likely going to be higher in the second half of the year, even given the Fed. The Powell put. So if you like the video, I'll have another one that's very interesting and very thoughtful. So hopefully you like listening to these. Thanks.